I think, if you started at the beginning of the year and said where inflation was now and the fiscal deficits, I don't think many people would expect 10-year yields to be not just low, but declining at this point. I think potentially one thing here that could be relevant is investors have shifted to thinking that instead of the Fed being behind the curve, the risk is the Fed is going to, be moving on the curve or even ahead of the curve over time. And with, very hot housing markets, a lot of debt in the US economy, maybe there's concern that as we look further out, and this is the 10-year bond yield, we're going to have a slowdown in growth and potentially even credit problems as the rates environment, which has been very low, starts to reverse.
You think the market is pricing in the risk of stagflation? I mean, I dare say, because if you're talking about growth cooling off or normalizing from the peak in 2021 and inflation risks persisting, given what we are seeing with commodity prices, would that be the way forward? Is that a scenario?
It's a scenario, Tanvir, but I think maybe the markets are pricing that the Fed is going to make sure inflation is not persistent, and so we'll be responding to make sure that doesn't happen. But more, I think, maybe not stagflation, but just more that so inflation turns out temporary, but growth slows down. We know the fiscal stimulus is going to fade, and monetary policy is going to tighten. And we know that there are some financial excesses in asset markets, in terms of credit markets. And so all that could put some headwinds and cause the growth picture to look weaker as you're looking towards, say, the second half of 2022 and beyond.